So imagine waking up one day, checking your phone and seeing that your money has grown overnight without you even lifting a finger. That's the power of investing. But if you're new to this, I know how it can feel overwhelming. Stocks, ETFs, crypto, I mean, you're seeing it all over socials, you're seeing it all over the news. But which one is actually good and which one can actually make you money? So where do you even start? And what if you make a mistake and lose your hard-earned money? By the end of this video, you'll know exactly how to start investing. I'm going to cover why investing is actually crucial, the different types of investments, how to avoid beginner mistakes, and most importantly, how to make your money work for you. So if you're sitting there thinking, why do I actually need to invest and why isn't savings just enough? So the harsh truth about saving money is if you had to put $10,000 into a savings account 30 years ago, how much would you have today? Maybe $12,000, maybe $13,000. If you had to invest that same $10,000 in the stock market, you'd actually have well over $150,000. Now, that's insane. So this is the problem with just saving alone. It doesn't grow fast enough to beat inflation, and inflation is actually really sneakily steals your money because over time, money left in the bank devalues, or just money in general devalues. So this actually leads to the question, what is inflation and why is it actually killing your money? So let's go back a little bit. In 1990, you could actually get a Big Mac for around $2. Today it's over $5. That's inflation in action. If you keep your money in a bank earning just 0.01% interest, but inflation is 3 to 5% a year, you're actually losing money every year. What's the solution? Investing. Because investing is the only way to grow your money faster than inflation. So now that you know that saving over time could potentially be a bad idea and investing is a solution, so the next step is to understand the different investment options. So the first one is stocks. Owning a piece of company. Imagine you could own a small piece of a company like Apple, Amazon, or Tesla. Well, that's exactly what stocks allow you to actually do. Stocks represents ownership in a company. When a company grows and makes more money, its stock price increases, and you as a shareholder make money too. So an example being a $1,000 investment in Amazon in 2010 is now worth over $15,000. So the second investment option is ETFs and index funds, the lazy investor's best friend. Or basically, if you don't really know much about investing or you don't want to be too hands-on, this is the option for you. So how this works is traditionally picking individual stocks is actually risky. What if you choose the wrong stock? That's where ETFs, exchange traded funds, and index funds actually come in. So an ETF is like a basket of stocks. Instead of buying one company, you're buying pieces of hundreds or even thousands at once. So an example is the S&P 500 ETF. This includes 500 of the biggest US companies. Historically, it has returned 8 to 10% per year on average. However, if you're thinking, you know what, I've got a lot of time and the money I invest now, I don't need it for the foreseeable future, then you can potentially invest in bonds. This is actually slower and a lot safer. So to put it bluntly, if stocks are like roller coasters, bonds are like slow moving trains. They offer lower returns but are much less risky. Bonds work like this. You lend money to the government or a company and they pay you interest over time. They won't make you rich overnight, but they can provide stability in your investment portfolio. But if you're sitting there thinking, you know what, I want to stay away from virtual investments, then real estate, this is turning properties into passive income, is the way forward. So real estate is actually a great way to build wealth over time. You can rent out a property for passive income or sell it at a later date for profit. So example would be buying a $200,000 home and selling it for $300,000 plus collecting rent along the way. The downside, it requires more money upfront and isn't as liquid as stocks. So what liquid means is basically easily accessible money. So if you buy a property, you can't access that money until you sell it, which could take months and hopefully not up to a year. So this next investment vehicle has actually been the craze for the past few years, and this is cryptocurrencies. This is high risk and potentially high reward. Part of the reason why crypto has been the craze over the past few years is, let's face it, crypto is actually exciting, but it's extremely volatile. Start small, only invest money you're willing to lose. And if you're new to investing, I wouldn't go down the crypto route until you know wagwan with investing. And the term volatile basically means that it just goes up and down very quickly and without any notice or any reason behind it. So if you're sitting there thinking, you know what, these investments actually sound good, I want to get involved, here's a step-by-step guide on how you can actually get started. So the first one is set your investment goals. Are you investing for retirement? Are you investing for a house? Financial freedom? Your goals will actually shape how you invest or which vehicle you choose, whether it's stocks, crypto, or real estate. And number two is choose the right investment platform, because not every investment platform is right for everyone. So to start investing, you need a brokerage account. Some great beginner friendly platforms are Robinhood. This is easy for stock investment. Fidelity, great for long-term investment. And Vanguard, this is best for actually index stocks or index funds. And by the way, this video, or I'm in no way affiliated with any of these brokerage platforms. I've just used them in the past. I've got personal experience. So I just giving you guys some tips on how you can start or where you can start. So now you've decided, I want to get into investment. I know which vehicle I'm going to use. I know which brokerage I'm going to sign up to. So how do you actually decide how much to invest? You don't need thousands of dollars to start. Even $50 or $100 per month can grow into hundreds of thousands or hundreds or thousands over time. So an example would be investing $100 in the S&P 500 for 30 years. This could actually grow to well over $250,000. I mean, in 30 years, that's a really good return. So the next step is actually to pick your first investment. If you're a beginner, start with an S&P 500 ETF like VOO or SPY. So that's the actual ticker for S&P 500, which is SPY. This way, you're investing in 500 companies all at once, and you don't need to worry about, or if this company is bad, or if this company is underperforming, or if this company is overperforming, or whatever. You don't need to keep reading balance sheets, know who the CEO is, know what the plans are. You don't need to know all of that. You just put your money in, watch your investment go. But if you're investing, you need to avoid these costly beginner mistakes. And the first mistake is actually timing the market. Many beginners try to buy stocks where they're low and sell when they're high. But even professionals can't do this consistently, because you just don't know what the market is going to do. You don't know where it's going to go. The best thing you can actually do if you want to start trading the market and stuff like that, buying here and there, is to let the market tell you what it's going to do. And this next mistake actually goes hand in hand with trying to time the market, and this is panic selling. So when the market drops, don't panic. The stock market always recovers over time. And with panic selling, how it goes hand in hand with actually trying to time the market is, you try to time the market, you say, let's say I'm going to buy because this is the bottom line of it. And then you buy, and then the market keeps going down. Of course, you're going to panic, right? Thinking, oh my God, I'm wrong. Let me get out. And then you sell, and then you might be right over time, but you're out the market, you're out the game. So another common mistake that people make is actually falling for these get rich quick schemes. If an investment sounds too good to be true, it probably is. In fact, it most likely is. Stick to professional investment strategies. And a lot of those are being told on this channel, where I analyze stocks, crypto, all of that. And you can follow those videos. But to be perfectly honest, the most successful strategy is actually the power of long-term investing. The biggest secret to investing is start early and be patient. Warren Buffett made most of his fortune after the age of 50 because of compounded interest. Imagine that. My guy has been trading for years and years, but only when he turned 50 and he had made a few billions, this is where he actually started making a lot of money, because he was patient enough. He waited for his money to start making money for him and waited for the market to actually really start going up. Warren Buffett's biggest secret is actually compounding interest. So guys, what you should always remember is that investing isn't about being perfect. It's about getting started. So the sooner you get started, the more time you have to let your investment actually make money for you. Thanks for watching, guys. I'll see you in the next video.